Welcome to another QuantInsti webinar. This is your host, Kshitij Maurya. I can see there are many people who have joined for the first time. And for that, a quick introduction to QuantInsti. QuantInsti is leading algorithmic trading and uh, training research institute that offers one of the world's most comprehensive ecosystems around quant and algo trading. Since 2010, we have helped millions of people in over 190 countries with our education initiatives. And we help people build expertise in this rapidly growing domain. We also enabled institutions to offer algo trading tools to millions of their users by leveraging QuantInsti's institutional grade technology and trading platform. Now, the topic for today's webinar is exploring options volatility, covering key properties, trading strategies, and backtesting. And for today's session, we will be joined by Akshay Choudhary. Many of you already know if you have attended some of our past webinars. So let's welcome Akshay. Hi, Akshay. Thank you for tuning in for today's webinar.
Hi, Kshitij. Thank you very much.
A quick introduction to our speaker. So Akshay works as quantitative analyst in the Quanta research and content team at QuantInsti. And prior to that, he worked as a data scientist with Geo. Akshay likes to trade options and read about market psychology. He holds a bachelor's degree from IIT Kanpur. Uh, and before we start today's session, I would like to share that please keep in mind that all the questions will be picked at the end of the presentation. So don't hesitate to share your questions in the Q&A section. And also remember that this session will be recorded and made available on QuantInsti's YouTube channel. So please subscribe there. And without any further ado, let's straight jump into today's knowledge pack session on exploring options volatility. Akshay, the stage is yours.
Thank you. Thank you, Kshitij, for the introduction. So yeah, we'll start the session. Okay. Yeah. So yeah, so as Kshitij told that today's session is about exploring options volatility. Okay, so yeah, so this is a disclaimer. Okay, so getting to the agenda of the session. So in today's session, we will cover what a IV skew or implied volatility skew is, okay, and which will be followed by some trading approaches by which we can take advantage of the IV skew. Then we will cover what mean reversion is in case of IVs, how it mean reverts, okay, and then we'll see some strategies which we can trade basic on this property of mean reversion. And towards the end of the session, we will be having an interactive Q&A session. So yeah, let's get started. Okay, so the first topic is IV skew. Okay, but before getting to know about implied volatility skew, we should know about what implied volatility is. Okay, so it is actually the market's forecast of the likely movement in a securities price. So if I were to explain you in simple terms, it is basically what market forecasts for the securities future. Okay, so basically what can be the movement in the price of that security. So that is basically what IV gives. And it is used to price the options contract. And basically, when there is a high IV, it means that there are higher premiums. And when there is a low IV, that signifies a lower premium. So there is one more thing related to IV. This is very important for the upcoming part of the webinar. So supply and demand and time value, these are some major determining factors for the implied volatility. So by supply and demand, I mean if there is a greater demand for a particular option, then its IV will be greater and vice versa. And from time value, what I mean is, let's say if an option is expiring 1 month from now and another option is expiring 2 months from now, then the IV of that 2-month option, which is expiring 2 months from now, will be greater. Because there is more room for the for the price movement in that particular time period of 2 months as compared to the time period of 1 month. Okay, so now we have some idea about what IV actually is. The next thing that we need to know before studying IV skew is the Black-Scholes model. Okay, so because this is basically everything from this is where from it all started. Okay, so in 1963, two mathematicians, Black and Scholes, Richard Black and Myron Scholes, they published a paper which was titled as The Pricing of Options and Corporate Liabilities. Okay, this was a paper which was published, and it actually described a method to determine the price of a call option. Okay, so that was there, and actually this paper actually changed the landscape of the entire option pricing domain. So this after publication of this paper, people realized that options could be traded with a defined risk. Okay, and this led to expansion of options trading, and finally establishment of the options exchange, like the Chicago Board of Option Exchange in 1973. So this is how it all started. Now everything was going well. Okay, and also, yeah, before that there is one more assumption. So in this Black-Scholes model, there was a very big assumption that the price of any asset follows a continuous time random walk. So by this, what we mean is the likelihood of any asset's price of having the likelihood of having a large move over a short period of time, that is, for example, a single day, it is very small. So this was the assumption on which this model actually was built. This mathematical formula of the model was built, and it worked. So yeah, from 1973, or let's say from the establishment of CBOE till 1987, everything was going fine, everything was working well. Then actually came the Black Monday of 1987. So on 19th of October 1987, the Dow Jones Index, which was actually the one and the only major index in the US markets that was there at that time, it fell by 22.6%. Okay, so this drastic fall actually forced the option sellers to to basically so the buyers exercised their right, which for the options contract that they had bought, and this forced the sellers to basically exercise it. Okay, so this is what happened. So what happened was that there was huge loss which was faced specifically by the option sellers who sold put options. Okay, so now market understood that there is a problem. Okay, so there is a problem with this particular model on which everything was being traded like since last 15 years. So this model actually performed very well in the normal market condition, but whenever there is some extreme event like this crash of Black Monday, it failed. Okay, so it failed to account those things. Now the market is smart. Okay, and it basically came out with a solution that the options which basically offer protection against market crashes, which is the OTM options, out of the money options, that should be priced higher. Okay, with with price with higher volatility than the options which are actually capturing the normal market moves, that is the options which are near the at the money strike price. Okay, so this is what solution was there in after this particular crash. So after this, the perception of everything changed. Okay, and the implied volatility curve started to look something like this. Okay, before that, people thought that it is a straight line. Okay, but then they kind of after this particular thing was done, this was actually thought to be as a curve. So in this particular curve, this is actually what a volatility smile is. Okay, so this curve, this looks like a smile when you see it on a screen. So that's why it's termed as volatility smile. So in this, what it signifies is the at the money options. Okay, those are priced at a very the IV of those at the money options is lower. It's on the lower end, and the IV of the out of the money puts and out of the money calls. So on the right side there are out of the money calls, and on the left side there are out of the money puts. Those are on the higher side with respect to the at the money options. So as we saw here, right, that this was a solution that so basically these out of the money options, what they do is they offer protection against the market crashes. So like the put options, so the buyer of the put options can basically buys them with a view that if their portfolio, the stocks in their portfolio crash, then the price of the option that they bought or the IV of the option that they bought, the put options will shoot up, and hence it will offer some protection against the crash in the market. So yeah, this was this was how the smile looked like. But actually, when we see in so this actually varies, okay, depending on the asset. So when we see, when we see the actual IV plot, the IV surface plot, so it looks something like this. So I think you might notice that the IV of the, so let's say the ATM strike price is at 40, okay, and if you go 30 30 points, 30 strike, like out of the money from this on the left side, then the 10 strike IV and the 70 strike IV are not equally, they don't have equal IVs, right? So the puts have higher implied volatility as compared to the calls, like for the equidistant strike from the ATM. So the reason for this is actually very interesting. So let's say I hold a portfolio, okay, of stocks. I have a portfolio of equities, okay. So what I'll do is I usually buy insurance against the market crashes, right? So that's why the demand for puts is usually higher as compared to the demand for calls in case of equities specifically, right? So if I have a portfolio that I'm usually long on that portfolio, so I'll buy an insurance which would basically help me when the market falls, and it would make me some money, so like an insurance, right? So that's why usually in equities the demand for out of the money puts are it is actually greater than that of the out of the money calls. And we have like we saw in the very first slide, right, that supply and demand actually it is responsible for the IV levels. Okay, so as there is a greater supply of out of the money puts, that's why the IV it is greater with respect to the out of the money calls. So this is how actually the curve looks like. The volatility surveys, this is how it looks like when you plot it. Okay, for any particular asset. The strike price of any particular asset. But similarly, so yeah, this is generally known as a reverse volatility skew. Okay, and but there is something which is quite opposite also. Okay, so there is for some assets there exists a skew which is actually quite opposite. That is the implied volatility IV levels for the out of the money calls are higher as compared to the IV levels for out of the money puts. Okay, so this is true for some asset classes. So yeah, here I have a quiz question for you. Interesting quiz question. Let me open that. Yeah, so basically you have to think and answer for which asset class can this reverse thing be true. Okay, so this forward volatility skew, right? The one which is shown on screen. For which asset class can this be true? Okay, so we'll have 10 more seconds, then we'll close the poll. Okay, so yeah, I'll just end the poll. Okay, so I can see that 34% of you answered equities. But for equities, we saw, right, that there exists a reverse skew, right? So for equities, this is the case for equities, right? Because as I gave you an example, that if I'm long on a stock portfolio, then I'll kind of buy puts, which will increase the IV levels of the OTM puts. So equities is unfortunately not the answer. So the correct answer for this is, as 29% of you answered, it's the commodities. Okay. So what happens for commodities is that there's a call hedging in commodities, right? Like similar to there is a put hedging, right? As we told that we'll buy put for equities, for commodities there's a call hedging. So that is usually done to prevent prevent the market participants, like they actually do call hedging to prevent themselves or to shield themselves from the spike in the commodity, right? So let's say if I am a person who wants to invest in a who is actually invested in a particular commodity, and I want to prevent the loss due to spike. Okay, so in that case, I will do a call hedging in commodities. Like for example, if I am a producer or a supplier of a particular commodity, let's say for some crops or for some mining commodities like gold or silver. In that case, to prevent, so usually in panic, what happens is these commodities price shoots up, right? The gold price shoots up, the crude oil price and all those things, okay? Due to demand and supply and due to this panic in the market. So I want to prevent myself from this, the loss which I might incur due to shooting up of this price, right? So that's why there is a call hedging in commodities, and that's the correct answer for this. Okay, so yeah, so let's now move to the applications in trading. So basically, until now we know that this is the skew which exists in the market. Okay, so we'll talk about the reverse volatility skew from now on, which is actually existent in the equities market. So I know that this is the skew. Now, how can I trade it? Okay, so yeah, so the first, so there can be 2 or 3 approaches to this. We'll discuss them. Okay. So the first approach is the kings which are in the skew curve. Okay, so you might, so in this particular curve, that skew curve that I have shown on the screen, you might see that there is a anomaly here, right? There is a mispricing which is there, right? Because the curve is supposed to be like this, right? It is supposed to be it is supposed to be something like this, but here the IV of the 30 strike option, okay, that is actually greater than that of 25 and 35 strike, okay. So this particular thing is actually due to mispricing in the options, okay. And how we can benefit from this is, so ideally this should normalize, right? The skew curve should return to its normal shape. Okay, so in this case, one method to trade this can be, you can short the implied volatility of this particular strike option, of this 30 strike option, and to hedge that position, you can go long on 25 strike option and 35 strike option. So hedging is actually necessary here because there can be 2 reasons for that. Sometimes it might happen that there is a very drastic movement in the market, which might lead to losses. To avoid that, hedging is a requirement. And the second thing is, sometimes it might happen that until the expiry also this skew curve doesn't correct itself, right? So due to some demand supply inefficiency, it doesn't correct itself. Then also you'll be basically in a loss. To prevent from those losses, to prevent yourself from those losses, there's a requirement to hedge. Okay. So that is there. So what we can do is we can deploy a butterfly spread where we can short 2 lots of this 30 strike option, and we can go long on 25 strike and 35 strike option, one lot. Okay, so that can be a strategy, but this is not so easy. Okay, there are some caveats in this. So the very first thing is this kinks or this bulges in the skew curve can also be due to some liquidity issues, right? So let's say there is a particular option is not liquid. Okay, then also these kinks in the skew curve might appear. Okay, so that is there. And the second thing is these are very short-lived. It lasts usually for milliseconds, right? So to exploit them, you need to have access to very fast or high frequency data, and you need to trade accordingly because these are very short-lived. And usually all those mispricings basically tend to return to normal. Okay. So yeah, these are 2 limitations. But yeah, if you can identify whether the kings are due to liquidity or it is actually a king, then it is possible to trade it. And secondly, if you have access to some high frequency data, then also you can trade this particular strategy. Okay, so so there is, but what if I want to trade it? Okay, what if I'm a retail trader and I want to trade this particular skew? So we have some approaches for that too. Okay. But before going to those approaches, we should first understand how the skew is actually calculated. Okay, so vol skew is actually calculated using a very simple formula. Okay, that is we have OTM put IV minus OTM call IV divided by at the money strike IV. Okay, so this is a formula which can be used to calculate the volatility skew. Okay. Now, ATM strike IV is a very straightforward thing. Okay, so that is basically, let's say if your underlying or if your at the money is at 5,000, so you'll take the IV of the 5,000 option. Now, whether to take that of the call option or put option, so you can take the average of call and put option of the ATM and decide this ATM, and this you will get this ATM IV, right? Now, the interesting part is for selecting the OTM. Okay, so I said OTM put minus OTM call. Okay, but how much OTM? How do you decide this particular OTM strike, right? So for that, we again have 2 approaches. So there can be multiple approaches, but there are very 2 common approaches which are there. So one thing is you can select it based on strike price percentage. Okay. So let me give you an example. So let's say your ATM strike is at 5,000. Okay. And you fix a strike price percentage, which is 2%. Okay. So ATM 2% will be your OTM call IV, and ATM minus 2% will be your OTM put IV. So in that case, your call OTM will be 5,100, which is 5,000 plus 2% of it, and your put IV will be 4,900. Okay. So yeah, this is one way of selecting the OTM IVs. Okay. So based on a fixed percentage method. Okay. But there is also a more efficient approach, I would say, for selecting these IVs. Okay, so that is actually based on delta neutral skew, approach. Okay, so let's say for selecting the OTM IVs, what if we use the delta method? Okay, so for people who are not aware actually of the delta, so delta is actually it is a Greek which tells you how the price of the option changes with the change in price of the underlying asset. Okay, so that is what delta signifies. Okay, and yeah, so now you can select this OTM IVs put and the calls based on this delta values also. Okay, so yeah, one more thing. So delta is usually near 0.5 for at the money strikes, and as and when you go out of the money, it like the value of delta reduces. Okay, so there will be some strike out of the money call strike with delta of 0.25. This 25 delta actually means 0.25 in if I talk in fractions. And similarly for put IV also, there will be a certain strike which is minus 25 delta. So yeah, actually delta is also the sign of delta also matters, because for call IV the delta is positive, and for the put IV it is negative, because so this thing is actually derived from whenever the price of the underlying increases, the call option price also increases, and vice versa happens. So when the price increases, the value of the put option decreases, right? So that's why the delta of it is negative. So yeah, so again taking another example. So let's say the ATM strike is again 5,000, and 25 delta call is at 5,200, and minus 25 delta is put is at 4,900. So you might notice one more thing. So the distance is not equal, right? The call strike distance for 25 delta is not equal to the put strike distance for minus 25 delta. This is again due to the existence of skew. Okay, so as there is a skew, well, there is a reverse skew in equities IV, so that's why this condition exists. Okay, so yeah, this can be another method. So basically, we ensure delta neutrality and calculate the skew. And actually, now there is one more question would pop up in your mind, that whether I should take 25 delta, 30 delta, 35 delta, 15 delta, right? So there is a very interesting paper which is titled as "What Does Implied Volatility Skew Measure?" So in this, actually, the author, who is Scott Mixon, he's also the chief economist in Commodity Futures Trading Commission. So he talks about, so he actually calculated the skews by different delta values, and he checked the stability, and then like he discusses his results. Okay, so this is also an interesting read. If you like are interested in exploring this different delta values, then you can go through this research paper. So yeah, this is very interesting paper. So yeah, coming back to the topic. So we now after this we have actually calculated the skew. So yeah, again I would like to I again have a quiz question for you. So yeah, so you are required to calculate. So I've given you this data. Okay, so this is the call IV, out of the money call IV. This is the out of the money put IV. So you're required to calculate the whole skew. So we have 20 more seconds until we close the poll. Yeah, I'm seeing that most of you are getting it correct. Okay, yeah, we'll end the poll now. So yeah, I can see that 90% of you got it correct. So the skew will be 0.4. Yeah, it will be 70 minus 13 by 10, which is put minus call by ATM IV. Okay then, so Yeah, so now we have calculated the vol skew. So now let's move to the approach for trading this vol skew. Okay. So again, there are two approaches for this that we'll discuss today. One is a traditional approach, okay, which is based on the traditional definition of a skew, and the second is a contrarian approach, okay. So both of them are actually interesting. So we'll first look at the traditional approach. So this thing, we already know the formula of the skew. Now, let's say if the OTM put IV is greater than OTM call IV. So this essentially means that there is more demand for puts as compared to calls. Okay, and as there is more demand for puts, as we discussed, that market has a perception of a probable downward movement. Okay, so that is the perception when this put IV is greater than call IV, or in other words, I would say when the skew is positive, right? If the skew is negative, that is the call IV is greater than put IV, then there is more demand for calls, right? Because we already established the relation about like in the IV and the price of the option, right? So that means that there is a market perception of of a probable upward movement. Okay. So yeah, so one strategy can be you just follow the trend, right? So if there is a perception of downward movement, you go short on the underlying asset. If there's a perception of upward movement, you go short, you go like long on the underlying asset. This is a traditional approach, right? So yeah, but there is another approach which is a contrarian approach to this. Okay, so what this contrarian approach says that we can take positions that profit from reversal of these skew patterns. Okay, and this is based on the belief that market's perception of risk is usually very exaggerated. Okay, so this is what the approach says, that we can basically trade on the reversal of these patterns. So I'll just formulate some signals for you here. So basically, when there is a skew which is greater than 10%, okay, or greater than greater than 10% or greater than 0.1, we'll go long, okay, and we'll exit the vol skew when we'll exit the strategy when the skew is less than 10%, right? So as we are trading on the contrarian approach, by the traditional approach, you might think that as the skew is positive, there is a chance for a downward movement. Okay, but as this contrarian approach says otherwise, okay, and it is again, it is basically based on the belief that the perception of risk might be exaggerated. So we'll go long on the underlying asset instead of going short. Similarly, for going short, we'll enter when the skew is less than -5% and exit when it is greater than -5%. Now, there is an imbalance in this threshold, right? The one is -5%, one is +10%. Okay, so this is actually because usually in equities market, the put IV is always usually greater than the call IVs, right? So seeing a negative skew is a bit rare, right? So that's why we have kept the threshold as a -5% so that we get at least some signals for the short position. So yeah, we have actually backtested this strategy. So let me take you to the backtester. Yeah. So here we have here we have backtested this particular strategy that we discussed. Okay, based. So one thing to note here is that this particular skew that we have calculated, it is based on delta neutral approach, right? So here we have actually backtested this on SPX end of month expiry options. Okay, and we have calculated the skew with this particular formula in Python. As I showed you, this is a formula for calculating the skew. Okay, so this is how skew is calculated, and then we have backtested it based on the conditions that we discussed in the slide, right? So basically, we'll enter long when the skew is greater than 10%. We'll exit when it returns to when it is less than or equal to 10%. And similarly for short, when it is when it is less than -5%, we'll go short. And if it is greater than -5%, then we exit it. So yeah, so we are doing the same thing here. We are just using the NP-ware condition in Python to generate the long and the short signal and the final signal for the skews. And yeah, we have backtested this strategy actually for a period from 2015 to 2023, and these are the backtesting results that we got. So the Sharpe ratio, the drawdowns, and all those things. So yeah, it was very interesting to see how this contrarian approach worked in the market. So yeah, this is how we have backtested. I've tried backtesting this particular strategy. So yeah, I think so yeah, the same thing can be done for the normal the fixed percentage strike also. Okay, so that has also been done. But yeah, as this delta neutral thing is a bit more efficient than calculating it with the fixed strike percentage. This is the basically this is the computation using delta neutral thing. So yeah, that is it. So I think, yeah, we have discussed until now the property of IV skew, which exists in the market, and how you can trade it. Now let's move to the second property of implied volatility, which is again a very interesting property, which is the occurrence of mean reversion in implied volatility. But yeah, again, as before that, we should first know about the volatility index, or what we call VIX. Okay. So VIX, or volatility index, actually measures the market's expectation of volatility, right? So like we discussed, right? IV is for options, individual options. So this VIX is for the for a particular asset, like for the in general, the general sentiment of the market, right? So in different markets, there are different indexes to like capture this. Like in US, we have CBOE VIX, which is Chicago Board of Options Exchange VIX, which is basically based on the S&P 500 index options. Similarly, we have India VIX for Nifty 50 options in India, right? So now how this is calculated is also very interesting. So it actually is a aggregation of the prices of the wide range of index options. Okay, so all the options most of the options which exist in the option chain are taken into consideration while calculating this VIX index. Be it for Nifty 50 or be it for S&P 500. So this calculation part is also very interestingly covered in one of the papers, which is there on CBOE website. So they have given a methodology for calculating this VIX, how they calculate it, and how they take the options, which options do they take, which they don't take, and what is the weightage given to that, and all those things. So yeah, this is also an interesting read if you want to know how this VIX is calculated. And usually in other parts, like in other indexes also, it is calculated in a similar way, like it is calculated in CBOE. Okay, so usually this VIX value is very easily available. So this data is available for India VIX as well as CBOE VIX. So we'll not go into the calculation part currently, but we'll focus more on the interpretation part. So high VIX actually implies that there is a higher volatility, and hence there is a uncertainty in the market. This is a general perception of VIX, right? And low VIX usually says that there is a low volatility and there is a chance of a more stable market in the future, in the upcoming future, right? So yeah, that is the general interpretation of how VIX, or the volatility index, is interpreted, be it CBOE VIX or be it India VIX. Now the next thing to note is VIX is an index, right? So you can't trade S&P 500, and similarly you can't trade Nifty 50, right? So similarly VIX is also not tradable, okay, as it is an index, but you can trade some futures and options and ETFs of VIX. Okay, so there are VIX futures, there are options with that for that futures, and there are ETFs like VIXC for CBOE, which actually trades based on CBOE VIX. Okay. So these are some ETFs which are tradable, but yeah, VIX as an index is not tradable. So yeah, so in the graph you can see on the screen, I have plotted the VIX, CBOE VIX for a period from 2010 to 2024. Okay, so can you guys observe something something from this particular graph? So yeah, I think you might have got it right. So this is related to the property that we were talking. There is a mean reversion, right? So wherever there is a spike in whenever there is a spike in this particular like in the VIX, okay, it tends to mean revert, right? So let's say here the VIX spiked, the index value spiked, okay, but it is reverting to its mean. Okay, so the mean would be somewhere near 20. Okay, so whenever there's a spike, like the recent one you can see during the COVID. Okay, so during the COVID panic, the VIX shot up till 80. Okay, and yeah, one more thing. So VIX is also known as the fear index. Okay, so because whenever there is a fear in the market, uncertainty of fear, it shoots up, right? So yeah, as there was uncertainty in the market about the vaccines and all those things, so that's why the VIX shot up till 80. Okay, but it mean reverted, right? It reverted to its mean. So it shot up and it went down. Okay, So yeah, this is one more property of VIX, that it always tends to mean revert or get back to its mean, right? So now, how can we basically trade based on this property? We know that there is a chance of mean reversion in the VIX, but how can we trade on this mean reversion? So we can have a strategy for that. Okay, so for this, basically for trading mean reversion, there are two essential conditions, right? So the VIX should be on the higher side, right? So basically, you have to, if you have to go short on VIX, you have to go somewhere near here, right? So the current the current value of VIX should be on the higher side. That is, it should have shown a strong momentum till now, right? And how do you basically calculate this, or how do you know that this is on the higher side? So you can use a mathematical concept of percentile, right? So what this percentile actually says, so let's say I say that VIX value is at 75th percentile. So what this means, yeah, and one more thing, percentile calculated over the period of last 1 year, right? I also need to specify that. So what that means is VIX is basically the value of VIX is on a 75th position with respect to the trading like range, with respect to the value range in the last previous 1 year, right? So it is on the higher side, right? It is above the 75% of the values, which are 70% of the previous year's values, right? So yeah, it should be on the higher side. And second thing that we talked about is how do we know that it is reverting, right? So there might be chances that it is higher, but it might go more higher, like it might go till 80, 90 or something, right? So so basically what I mean to say is the strength should be decreasing, right? So there should be a loss of strength of the uptrend. Okay, so that we can easily check using one of the indicator, which is a very common indicator, you all might be knowing about it, which is RSI, which actually tells the strength of the trend, right? So yeah, so basically we need VIX on the higher side, and we also need the trend strength of that particular high like upward trend to be decreasing. Okay, so then we can basically take a trade based on the mean reversion thing. So yeah, so we can generate the signals, the short signals in this format. So basically, as we talked about, the VIX should be greater than 75th percentile. That means it is on the higher side, okay, of its historical range. So this time period can vary. It can be the standard thing to take is usually we take 1 year, but it also depends on your assets volatility cycles. So if the volatility cycle of your asset is less than 1 year, let's say it's 6 months, or it is like some other value, then you can take the historical range as per that, right? But yeah, usually equities we take it as 1 year, and also the RSI value should be less than 50. Okay, so this actually means that the VIX is relatively high, but the momentum, which is actually shown by RSI, indicates that it might not continue rising. Okay, so that can be a signal for going short. Okay, and similarly, the exit signal can be when the VIX falls below 25th percentile of its historical range, okay, or the RSI value is greater than 50. Okay, so here we have the or condition because, yeah, as I said, volatility is mean reverting, right? So if it falls below 25th percentile, then again there is a chance of it reverting back. I mean, it can go from lower value to the higher value, right? There's a chance of going back to its mean. So we don't want to be like in that trade when it increases, right? So that's why we'll exit it when it is below 25th percentile, or else RSI starts to increase. That is, it shows a potential upward movement. Okay, then it might not be a ideal condition for us to hold that short position. Okay, so that is the exit signal that we have. And also, like as I said, VIX is not tradable. So what we can do is we can generate these signals on VIX, and we can take the trade on VIXC, which is actually a tradable ETF of VIX, which yeah, in the US markets. So yeah, here we have the short signals and the exit signals. So let's see how how the backtesting of this strategy, how do we backtest this? Okay. So yeah, we have we have imported the data for VIX as well as for VIXC from 2014 to 2024. So we have 10 years of data for VIX as well as VIXC, and we calculate these values. So basically, we calculate the indicator values and the 25th and 75th percentile, the RSI value and the 75th and 25th percentile. And now we have so this is how the 75th percentile and 25th percentile looks like. So this dotted red line that you see is the 75th percentile of the previous 1 year of VIX, and this green line is the 25th percentile. Okay, so we'll generate signals. So as we discussed, we'll generate signals when VIX crosses above 75th percentile, and there is a loss in the value of RSI. That is, there is a loss of momentum. Okay, so that is the entry condition for going short. Similarly, we will close that particular trade when it falls below 25th percentile or the RSI value starts to increase, right? We have a or in the exit condition and a and in the entry condition. So yeah, this is how the signals will be generated. Okay, and we have this strategy which actually with this particular backtesting and performance. So yeah, basically what we did is we traded whenever it went up, and we basically based on these particular entry conditions, we traded whenever it was coming down after being at the top, and the RSI value also started to decrease, and we exited our position when it fell below the 25th percentile or the RSI crossed above 50. So yeah, this is one way how you can basically trade the mean reversion in VIX using VIXI, which is an ETF. Also, we have used the RSI indicator here, but yeah, other indicators or a combination of indicators can also be used, like moving average crossovers, the golden cross or the death cross, 50 to 100 crossover, any other values of moving averages can also be used. Similarly, ADX and other indicators can also be used for capturing this particular mean reversion. So yeah, I think that's it. We have discussed the strategy, and yeah, so I think Kshitij, over to you.
Thank you so much for this wonderful presentation, Akshay. And now we'll start off with the question and answer session, and I'll request everyone to put their questions in the Q&A section. Uh, and I already have shortlisted some of the questions. So meanwhile, Akshay, you can go through it. And while Akshay is going through these questions, I would also like to share that our new course, Advanced Option Volatility Trading Strategies and Risk Management, is currently available at flat 75% off with the introductory offer. And I have shared the link with everyone in the chat. So in case you are looking to know more about these advanced options volatility trading related strategies, risk management techniques, do check it out and take a free preview. Definitely, that's worth a shot. So you can take a free preview and then also decide if you need to enroll in it. And another thing is, I would also like to highlight that apart from the 75% off offer, we also have Contra's all courses bundle, which offers 50 plus courses through 8 learning tracks. Now, the special thing about this all courses bundle is you gain a solid foundation in quantitative trading through a wide range of courses covering essential concepts, and there are also advanced strategies and also practical tools. On top of all of this, you will also have access to placement support through our network of 300 plus partners in over 20 countries. This is a limited time offer, and all of this with 85% discount. And this discount is only available for the next 4 hours. So in case if you are serious about moving towards the quantitative trading side or towards algorithmic trading side, you want to upgrade, this is the right opportunity, right time. There is a limited time offer. You want to start a career, move to a career into quantitative trading. This is the opportunity where there is a limited time offer of placement support through these Contra courses. Please make sure that if you are serious about this, please make sure that you are getting benefit out of it. And in case if you need any guidance on any of the courses, and if you also want to explore any of the payment options, I would also suggest to get in touch with our team. I have shared the link. Just book a slot, and some of our experts will connect with you. Try to understand what is it that is your requirement areas, then strategies or automations that you want to explore, and our experts will be able to help you guide in the right direction. Like these are the courses or these are the learning tracks that you can explore, and you can also take free previews. You can also explore payment options there. So please make sure that you book a slot with one of the course counselors through this link, and get answer to any of your questions. Okay, with that said, I think Akshay, I guess there are some questions, and I
Yes,
would
yes,
request
Kshitij.
you to pick them up.
So there was one question about the data. So it was about how you can get the data for this VIX indexes. So yeah, I think you can get it from Yahoo Finance. Okay, so you can you can fetch the data from Yahoo Finance. So it can be a source for getting the VIX data, especially on the daily time frame. Okay. Then the second question is it is actually based on the skew calculation thing. So are we assuming the same expiry for vol skew calculation? So yes, Kedar, we are actually assuming the same expiry, okay, when we are calculating the skew. So everything is same, only the strike prices and the strike prices are different for calculating the skew. So this is answered. And okay, I can see. Okay, so Ankit has asked mean reversion in VIX, Indian context, please. So Ankit, currently there are no assets which are which is basically based on the VIX, India VIX. Okay, it used to trade. There was NVIX, which was traded sometime, which started trading near 2014. But currently, I don't think there is any asset which is available to trade VIX, India VIX in India. Can we use, so there is also one more question. Can we use options to exploit the volatility spike? Yes, options can be used to exploit the spike. So what you can do is you can basically calculate. I mean, once you have a signal that there is a spike in the option, you can deploy a straddle, okay, straddle or a strangle, okay, to basically get advantage of that spike. So basically, you can deploy a long straddle kind of thing if you want to exploit the volatility spike using options. Right? And then okay, so Pierre has asked, what is the comma smile is called? Why is the comma smile is called forward or skew? Here, the word forward has nothing to do with forward and equity forward. No, so basically, it is actually interchangeably called. Sometimes it is called a forward or a reverse volatility skew, and sometimes it is also called a positive or negative skew. So I just use the term forward and reverse so that you might not get confused with the positive and negative values in that particular graph, right? So yeah, that is it. It has nothing to do with the equity forward. Okay. So yeah, so Ankit, I think your question was about the calculation in the quiz that was there. So the at the money strike had IV of 10, and the OTM put had a IV of 17, and the OTM call had a IV of 13. So as we said that, as we saw in the graph, right, that at the money IVs on the lower side as compared to the OTM IVs, but in that too, the OTM put is has a higher IV with respect to OTM call, right? So that's why this calculation was there, which was 17 minus 13 by 10, which was actually 4.4. Okay, Kedar has asked another question. Is there any method to determine VIX reversal levels? Can we use RSI? Yeah. So we saw how RSI can be used to determine the reversal levels. But yeah, there can be other indicators also that can be used. Like, as I said, moving average crossovers can be used, or ADX can be used, or some other indicators which can identify the reversals. Shashi has asked that can we trade with any broker or we need any specific trader? So yeah, you can trade with any broker, provided it provides you the required data, okay, or it provides you to place orders for the required assets. Like if you want to trade on, let's say, options in India, then yeah, in anywhere in the world, then your broker must be must provide you with the options data for generating signals, and also it should allow you to place orders on those assets. You can trade it like with any broker that has that satisfies that particular requirements. Harshil has asked what data should be kept in mind to plot volatility skew. So yeah, I think the data we have so I have also actually plotted the vol skew for a particular day. for the SPX options. So I would like to show you the plot that I have used. Yeah. So yeah, this is the this is where I have plotted the IV skew.
Akshay, we can't see this thing. Yes,
Okay. Oh, sorry. Is it visible, Kshitij, now?
yeah, it is visible.
Yeah. So yeah, here actually I have plotted the IV surface, okay, for a particular day, which is uh, I think 28th of December, 18th of December 2023. This is for the SPX options. So this is how the skew was plotted. So basically what I did is I plotted it using the OTM option values. Okay. And here there is one more interesting observation that you can see that there are gaps here, right? As you go more out of the money, there are gaps. So this is actually one reason for these gaps are due to the liquidity issues, right? So the strikes in between here are not liquid. Okay. So that's why there are gaps. It's not traded, it's not liquid. So that's why there are gaps. So yeah, you can plot it using the OTM IVs of both calls and puts on left side of the basically when your strike is less than the ATM, you can use OTM puts, and when your strike is greater than the ATM strike, then you can use OTM calls and plot this particular skew. So yeah, it is actually very interesting to see this plot, and yeah. So this was answered. I think. Um, Nitin has asked volatility skew time frame for trade. So yeah, these trades are actually taken on daily data. Okay, so we have actually daily data uh, which is used actually in this particular strategy. Okay, so yeah, we have done all these trades on daily data. So options data is also daily, and the underlying data is also daily. But yeah, this can be applied to any data. Like if you have minute frequency data, or if you have any other frequency data, you can apply the same concepts to that data also. Nitin has also asked one more interesting question. Can we roll options based on underlying movement? Yeah, it is possible. So if you want to roll the option contracts, you can do it. Okay. So yeah, it is possible based on the contract. So basically, then that case, you won't have the expiry condition for exit, because you can anytime roll over the option based on the underlying position, and you can continue that particular trade instead of exiting at expiry. Okay. I think. Yeah, I think most of the questions have been answered. Yeah, so actually, I think there is one more question to provide the links for the research papers. So yeah, we'll be sharing the links along with this presentation thing. We'll also be sharing the links of those two research papers that I talked about. One of Scott Mixon for determining the optimal delta values, and another one for the CBOE VIX calculation. Okay.
I'm still seeing there are a lot of questions that are related to if this recording will be available or not. So I will again clarify that this recording, the webinar is recorded and it will be available and will be shared with you all at the end of the webinar. So after the webinar ends, after 1 hour, we will be sending the recording along with the exclusive offer that I just shared, and also the the recording, we keep it, everything will be shared on email, so that you can refer to that. And if you have any questions, you can reply to that email with any of your questions, and we would be glad to answer any of those questions. And meanwhile, I think since most of the questions that we have seen here are answered, and there are many more questions that are coming up that are related to the new course. Uh, and also there, I can also see there are certain questions in terms of overlap of this new course with EPAT and all of that. And I have also seen some questions related to payment. So I would request for all of these course related queries, people who are asking these questions, please, book a time slot with one of the course counselors. They will be in a perfect position to take some time out and explain you everything in detail, and will help you with a path that is based on your learning objective, and that will help you improve your trading and achieve the systematic trading method in the way you do daily trading. So yeah, I think with this said, I think again I would like to thank Akshay for taking his time out, and I would also like to thank everyone. A big thank you to all of you who participated in today's webinar. And in case any of your questions, queries that remain unanswered, feel free to ask them in the webinar survey that you are going to get after this webinar ends. And I will see you in our upcoming sessions. Have a great day ahead. Bye for now.
Thank you, Hitesh.